Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that's not just trending, but fundamentally reshaping our world: artificial intelligence. You've heard the buzz, seen the headlines, and probably even used AI in some form. But have you ever wondered where the real money is flowing in this AI gold rush beyond the flashy chips and software? Get ready, because we're about to uncover a massive, often overlooked opportunity that could be a game changer for your investment portfolio. The world of artificial intelligence, or AI, is experiencing a veritable gold rush right now. Companies are pouring resources into developing and deploying AI-powered operations, all in an effort to gain an edge, whether that's through increased efficiency or by attracting new customers with cutting-edge AI features. It's a trend that's not going unnoticed by the financial world. This isn't just a fleeting tech fad. It's a foundational shift in how businesses operate and innovate. In fact, UBS reports that global spending on AI is projected to hit a staggering $375 billion this year, and is expected to climb to an even more astonishing $600 billion by 2026. That's a massive amount of money, and it signifies a fundamental shift in how businesses operate and invest. This isn't just about creating cool new apps. It's about transforming industries from healthcare to finance, manufacturing to entertainment. But here's where things get interesting, and perhaps a little more nuanced than you might initially think. As BlackRock CEO Larry Fink recently pointed out in an interview, investing in AI isn't just about buying the flashy components that make the headlines, the chips and the processors. He articulated a much broader vision, stating, "Investing in AI does not just mean investing in GPUs and chips. It means investing in HVAC and IT, investing in power grids and power supplies." This perspective opens up a whole new vista of opportunities, moving beyond the obvious players in the semiconductor and software spaces. Fink's insight is crucial because it highlights the entire ecosystem required for AI to thrive. It's like saying you can't just invest in the car engine. You also need to invest in the roads, the gas stations, and the maintenance shops. For AI, this means the physical infrastructure that supports the immense computational demands. It's about the foundational elements that allow those powerful chips to actually do their work. If you've been following the AI boom, you've likely encountered the big names: semiconductor giants like Intel, NVIDIA, Broadcom, and Advanced Micro Devices, or the hyperscale cloud providers such as Microsoft, Amazon, and Alphabet. These are undoubtedly solid companies, and they are absolutely central to the AI story. They are the brains of the operation, designing and deploying the algorithms in the core processing units. However, if you're looking to heed Larry Fink's advice and explore AI from a different angle, perhaps one that offers a blend of growth and income, you might want to consider a rather unexpected player: a real estate investment trust, or REIT, like Digital Realty Trust, ticker symbol DLR. So let's pivot from the chips and the code for a moment and talk about the sheer, unadulterated hunger for computing power that AI demands. At its core, AI, especially the sophisticated models we're seeing, emerge today. Think large language models, or LLMs, and the rapidly advancing field of generative AI. These systems are computational beasts. They require an immense amount of processing power to train, to run, and to deliver their impressive results. This isn't just a slight uptick in demand, it's a seismic shift in the requirements for digital infrastructure. This translates directly into an escalating need for specialized hardware. We're talking about vast arrays of graphics processing units, or GPUs, which are the workhorses for AI computations, alongside central processing units, or CPUs, and incredibly high-speed networking components to ensure all these parts can communicate effectively and without delay. It's a hardware arms race, driven by the insatiable appetite of AI algorithms. These components are not just powerful, they are also incredibly energy-intensive. Now, imagine thousands, even millions, of these powerful processors working in tandem. What's the immediate consequence? Heat. Lots and lots of heat. These sophisticated chips, when pushed to their limits, generate an enormous amount of thermal energy. And to keep them running efficiently and reliably, you need robust cooling systems. This brings us to another critical factor: energy consumption. powering these massive compute farms requires an extraordinary amount of electricity, often demanding dedicated power infrastructure and reliable supply chains. Picture this flow. Data comes in, it's processed by these incredibly powerful AI models running on specialized hardware, and then the results are sent back out. But before any of that can happen, the hardware itself needs a secure, stable, and appropriately equipped environment. The sheer scale of AI processing, from the initial training phases that can take weeks or months on massive datasets, to the constant demand for inference, where the AI model actually performs its task, all of this necessitates physical infrastructure. This infrastructure needs to be designed for high density, meaning fitting a lot of computing power into a relatively small space. It needs immense power delivery capabilities, and it must incorporate advanced cooling technologies to manage the heat generated. This is precisely where data centers step onto the stage, not as the star performers, but as the indispensable supporting cast, the unsung heroes of the AI revolution. They are the physical backbone, the concrete and steel structures, the intricate networks of power and cooling that enable all the dazzling digital capabilities we associate with AI. Without these robust, purpose-built facilities, the AI revolution as we know it simply couldn't happen. They are the essential body that houses and powers the AI brain. So if AI is the brain, what then is the body that houses and powers it? That's where companies like Digital Realty Trust come into play. Digital Realty, or DLR as it's commonly known, is a significant player in the data center space, and it offers a compelling way to invest in the foundational infrastructure that AI relies upon. But before we dive into DLR specifically, let's take a moment to understand what a real estate investment trust, or REIT, actually is. In essence, a REIT is a company that owns, operates, or finances income-generating real estate. Think of them as a way for individual investors to own pieces of large-scale real estate portfolios without having to buy, manage, or finance properties themselves. The primary way REITs generate revenue is through collecting rent from their properties. They pool investor capital to acquire, manage, and often develop real estate assets. And then they distribute the rental income generated back to their shareholders. This structure is legally mandated to distribute at least 90% of their taxable income as dividends, making them attractive for income-focused investors. Now, how does Digital Realty Trust fit into this picture? DLR is a specialized REIT that focuses specifically on data centers. Their business model is centered around owning, developing, and managing these critical facilities. They lease out space within their data centers and provide the essential infrastructure services that tenants need to operate their IT equipment. This includes robust power systems, advanced cooling solutions, high-speed connectivity, and stringent security measures. It's a comprehensive package designed to meet the demanding needs of modern digital operations. Who are DLR's tenants? Typically, they are large enterprises, hyperscale cloud providers, the very companies like Amazon, Microsoft, and Google that are building out massive AI capabilities. And increasingly, companies that are directly focused on developing and deploying AI technologies. These organizations require data centers that are not just large, but also highly reliable, scalable, and capable of delivering the high-performance computing environments necessary to run their complex AI workloads. And crucially, DLR's global footprint is a significant asset. With data centers located in key markets around the world, they can serve the geographically distributed needs of AI development and deployment, ensuring that companies can place their infrastructure close to their users or their data sources, minimizing latency and maximizing efficiency. Now that we understand the foundational role of data centers and DLR's position within that ecosystem, let's dive into why DLR is particularly well-suited to capitalize on the current AI surge. The core driver here is the unprecedented demand for data center capacity that AI workloads are generating. It's not just about needing more servers, it's about needing more power and more sophisticated cooling to support the specialized hardware that AI relies on. Traditional data centers built for general-purpose computing often aren't equipped to handle the intense power density and heat output of AI-specific hardware. This means that data centers need to be upgraded, or in many cases, purpose-built specifically for AI. And this kind of upgrade or new construction requires significant investment. Companies are looking for facilities that can deliver higher power densities per rack, often in the tens of kilowatts, and they need advanced cooling solutions, whether that's direct liquid cooling or other innovative methods, to keep these powerful systems from overheating. This is where DLR's existing infrastructure and their development pipeline become incredibly valuable. They are actively investing in and building out facilities that are designed to meet these evolving, more demanding needs. They offer the high-density power solutions and the advanced cooling technologies that are absolutely crucial for supporting large AI clusters. Furthermore, as AI becomes more integral to businesses, many companies are finding it more practical and cost-effective to outsource the management of their complex infrastructure. They want to focus their resources and their talent on developing their AI models and applications, rather than wrestling with the intricacies of power, cooling, and physical security. This is where co-location providers like DLR shine. They offer the expertise and the infrastructure to manage these critical elements, allowing their tenants to concentrate on their core AI development. The shift from traditional IT infrastructure to AI-intensive computing creates a clear opportunity for data center providers like DLR to offer higher value services. Consider the specific requirements that AI brings to the table. Lower latency is paramount for real-time AI applications, where split-second decisions matter. Massive data storage is needed to house the ever-growing data sets that fuel AI models. And secure environments are essential to protect sensitive data and proprietary algorithms. DLR, with its global network, its focus on reliability, and its capacity for high-density, high-power deployments, is strategically positioned to provide these critical solutions. They are essentially building the physical enablers for the next wave of AI innovation. Beyond the operational and capacity aspects, let's examine the financial implications for DLR and, by extension, for potential investors. Digital Realty Trust aims to offer investors a compelling dual benefit: capital appreciation, meaning the potential for the stock price to grow over time, and regular income, primarily through dividends. The growth potential is directly tied to the increasing demand for data center space, particularly for these high-demand AI workloads. As more companies need to house their AI infrastructure, rents tend to rise, and DLR's ongoing development of new facilities and expansion of existing ones contribute to this growth trajectory. The income potential is a fundamental characteristic of REITs. As a real estate investment trust, DLR is legally obligated by tax regulations to distribute at least 90% of its taxable income to shareholders each year in the form of dividends. This structure ensures that investors receive a regular income stream, making DLR particularly attractive to those who prioritize yield and steady returns alongside potential capital growth. This dividend provides a tangible, ongoing return on investment, which can be a significant component of an investor's total return over time. The company's financial stability and its proven track record in managing large-scale, complex data center operations are key factors that support the sustainability of its dividend. Of course, managing a business like DLR involves a delicate balancing act. They need to invest heavily in capital expenditures, CAPEX, to build new facilities, upgrade existing ones, and stay ahead of technological advancements to fuel future growth. Simultaneously, they need to maintain sufficient profitability to continue making those attractive dividend payouts to shareholders. It's a challenge, certainly, but one that DLR's management team is focused on navigating effectively. A significant factor underpinning the income aspect of DLR's investment proposition is the long-term nature of its data center leases. These aren't short-term rental agreements. Typically, DLR enters into multi-year contracts with its tenants, often spanning 5, 10, or even 15 years. These long-term leases provide a high degree of revenue predictability and stability, creating a solid foundation for consistent cash flow and, consequently, for reliable dividend payments. This predictability is a hallmark of well-managed REITs, and a key reason why they appeal to income-oriented investors. Now, let's delve a little deeper into the practicalities and the specific challenges that DLR and the data center industry at large are navigating. The demand for AI compute isn't just a gentle swell, it's a tidal wave, and this wave has specific requirements. We're talking about a shift from what we might call standard IT loads, where a server might consume a few kilowatts of power, to AI loads that can easily push 20, 30, or even 50 kilowatts per rack. This isn't a minor adjustment, it's a fundamental re-engineering of data center design. Think about the implications. Traditional data centers, built even just 5 or 10 years ago, simply weren't designed for this kind of power density. The electrical infrastructure, the transformers, the switchgear, the cabling, often needs to be significantly upgraded or completely replaced. And then there's the heat. Those GPUs and high-performance CPUs are generating an incredible amount of thermal energy. Simply blowing air over them, as is common in many older facilities, becomes inefficient and, frankly, insufficient. This is why liquid cooling is becoming not just a buzzword, but a necessity. Digital Realty and its peers are investing heavily in these advanced cooling solutions. This can involve direct-to-chip liquid cooling, where coolant is pumped directly to the hottest components, or more sophisticated air handling systems that are designed to manage the higher heat loads. These aren't trivial upgrades. They require specialized engineering, significant capital investment, and a deep understanding of thermal dynamics. But the payoff is clear. DLR can offer facilities that can accommodate the most demanding AI hardware, and they can command a premium for doing so. This positions them as a preferred partner for companies building the next generation of AI infrastructure. Consider the concept of power density. For a long time, data center operators focused on maximizing the number of servers they could fit into a given space. Now, the focus is shifting to maximizing the power available to each server. This means not just more electricity, but more reliable electricity. AI workloads are often mission-critical. An outage, even a brief one, can be incredibly costly, not just in terms of lost productivity, but also in the potential for model degradation or data corruption. So, redundancy in power supply is paramount. This often involves multiple utility feeds, robust uninterruptible power supply, UPS systems, and large-scale backup generators. DLR's expertise in managing these complex power systems is a key differentiator. They are not just renting out space, they are providing a highly engineered, mission-critical utility. And this brings us to another crucial aspect: the location of these data centers. AI training and inference often require proximity to both data sources and end users to minimize latency. This means that DLR isn't just building data centers anywhere. They are strategically placing them in key digital hubs, often near major metropolitan areas or critical network exchange points. This geographic advantage allows them to serve a diverse range of clients, from hyperscale cloud providers who need to serve millions of users, to specialized AI startups who need to be close to their talent pool or their data sources. Their global footprint, therefore, is not just about scale, it's about strategic positioning within the global digital infrastructure. Let's talk about the economics of this from DLR's perspective. Building a new AI-ready data center is a massive undertaking. It requires land acquisition, extensive construction, the installation of highly specialized electrical and cooling systems, and robust network connectivity. This is a capital-intensive business. However, the long-term leases that DLR secures with its tenants help to underwrite these investments. When a major cloud provider or an AI company signs a 10-year lease for a significant portion of a data center, it provides DLR with a highly predictable revenue stream. This predictability is what allows them to secure financing for these large projects and, importantly, to sustain their dividend payouts. Furthermore, the increasing demand for AI-specific infrastructure means that DLR can often negotiate higher rental rates for these specialized facilities. It's a classic supply and demand scenario. The supply of true AI-ready data center capacity is, for now, limited relative to the rapidly growing demand. This imbalance creates pricing power for providers like DLR. They can charge more for a facility that can reliably deliver 40 kilowatts per rack with advanced liquid cooling than for a facility that can only handle 10 kilowatts with traditional air cooling. Now, it's important to acknowledge that this isn't a risk-free investment. The data center industry, like any real estate sector, is subject to economic cycles. A significant economic downturn could slow the pace of AI development and, consequently, the demand for data center space. Competition is also a factor. While DLR is a major player, there are other large data center REITs and private operators vying for market share. Technological obsolescence is another consideration. While DLR is investing in advanced technologies, the pace of innovation in AI hardware is so rapid that facilities need to be continuously upgraded to remain competitive. This requires ongoing capital expenditure, which can impact profitability and dividend growth. However, the secular trend towards digitalization and the undeniable power of AI suggests that the long-term demand for data center infrastructure is likely to remain robust. Think about the sheer volume of data being generated every day, from social media, from IoT devices, from scientific research, from financial transactions. All of this data needs to be stored, processed, and analyzed. AI is the engine that will unlock the value within this data, and that engine needs a place to run. Let's consider an analogy. If AI is the new electricity, the fundamental utility powering the modern world, then data centers are the power plants. They generate, manage, and distribute this digital energy. And just as investing in the power grid and the transmission lines was crucial for the spread of electricity in the 20th century, investing in data center infrastructure is crucial for the AI revolution of the 21st century. Companies like DLR are essentially building and operating these digital power plants. Another way to frame this is through the lens of scalability. AI models are not static. They are constantly being trained on new data, refined and scaled up to handle more complex tasks. This requires data center infrastructure that can scale alongside these AI models. DLR's modular design and global footprint allow them to offer this crucial scalability, ensuring that as AI evolves, the physical infrastructure can keep pace. So, to wrap things up, as we look at the broader landscape of AI investment, it's easy to get caught up in the excitement surrounding the chip manufacturers and the software developers. These are undeniably critical components of the AI revolution. However, as Larry Fink wisely pointed out, the infrastructure that supports these technologies is equally vital and often overlooked. Companies like Digital Realty Trust are at the heart of this infrastructure, providing the physical spaces, the power, and the cooling that enable AI to function and to scale. For an investor seeking exposure to the AI megatrend, DLR offers a unique proposition. It's not just about betting on the growth of AI algorithms or the innovation in chip design. It's about investing in the tangible, physical foundation upon which all of that innovation is built. DLR's business model, centered on owning and operating essential data center infrastructure, positions it to benefit directly from the escalating demand driven by AI. The company's strategy of developing and managing high-density, high-power facilities, coupled with its global reach, makes it a compelling choice for companies at the forefront of AI development. And for the investor, DLR presents the potential for both capital appreciation as the demand for its services grows, and a consistent income stream through its dividend payouts, a result of its REIT structure and its commitment to returning value to shareholders. It's a way to participate in the AI boom through a different lens, focusing on the essential, often unseen, infrastructure that powers our increasingly digital and intelligent future. If you found this deep dive into AI infrastructure and Digital Realty Trust insightful, don't just stop here. Do your own thorough research on DLR, ticker DLR, and other data center REITs to see if they align with your investment goals. Check out their latest earnings reports, analyst ratings, and dividend history. And if you want more content like this, exploring the hidden gems and foundational plays in the tech world, make sure to hit that like button, subscribe to the channel, and ring the notification bell so you never miss an update. Let me know in the comments below. Are you investing in AI's backbone, or are you sticking to the chips? Your insights are always welcome.